So I wanted to create a video to talk a little bit more about some of the due diligence that we perform. So my mission is to help investors achieve financial freedom, okay? That financial independence that you have by having enough passive cash flow that you don't have to work. So we provide the education, the strategies, and the opportunities to enable you to do that. But if these opportunities are too risky, then we fail to achieve our mission. That's why due diligence is so important, because we want to make sure that you are achieving financial independence, and that requires that those opportunities not just disappear and you lose your money. So to that end, due diligence is super important. And there's several parts of it, and I want to go through each of those parts of what we do our research on. So due diligence starts with management and the people. With each opportunity, we try to figure out or get to know the manager. So is it someone we can speak with? Is it someone we know? Someone we can do a background check on? Someone we've met before in the industry? What do we know about that manager, that individual that is running that organization? And I love to do face-to-face events. I've been able to meet some of the managers face-to-face, in person, sometimes face-to-face online via Zoom meetings, things like that. But some of them, they do workshops and conferences and things like that, where you can go meet the president, the vice presidents, the people who run the company. And that's a great opportunity to really see and get to know who is running that company. That's very important. So getting to know the person and the people running it, very important. That's the management. Now, sometimes we don't get to know that. There's a few really good opportunities that I'm in that are getting great returns, and they check all the other boxes. But when it comes to transparency, they've actually had a third party do an audit. So I've got a couple of these. I can connect and talk to the CEO online, the trader online, and so we're connecting. But all I know is their Telegram name, for example. With that said, they've had a third party company that does audits that audited what they call a KYC, know your client. And so they've checked their background, everything about them. And so there are third parties that can do some of that auditing for you if you don't get a chance to actually meet the individuals yourselves. And so those are a couple of things that we get to do to screen some of these companies and who's running them. That's the single most important thing. Who's running them? How well do you know them? What is their experience? What other projects have they done? Did they fail in their last 3 projects? And this is number 4. Important to know. So knowing who is running the companies, super important. First part of due diligence. The second part is a third-party audit. And so I like to think I'm not an idiot, but I'm not a wizard when it comes to technology. And so there are firms that audit the blockchain technology and the coding to make sure that it's written properly. Because a lot of these are, some of them are what they call smart contracts, and there's different things with the blockchain. And if they're written properly, it protects us as investors, because the software and the coding, or whatever you want to call it, I mean, that's what runs things. And so these auditing companies will come in and make sure that everything is done properly to protect us from that. And so there's several of those. Another thing along those lines is there's some of the opportunities have what they call a third-party multi-sig. And all that means is a third-party auditor, an independent third party, it has to sign off or do a signature, multi-signature, on any funds that are moved. So even the manager of the company, they can't just go invest $100,000 in whatever they want to. It has to be signed off by the auditing company, the third party. So they couldn't just take the money and run. They can't invest it in stuff that doesn't meet the criteria. And so having those third-party auditing protections in place is a big part of how you can protect yourself by working with companies that offer that. The third thing we look for, and this is one of the most important, is transparency. So the reason transparency is so important is this: high returns are hard to achieve. And if you cannot generate high returns, it's probably a Ponzi scheme. In other words, where's that money coming from? If they say they're paying 1% a day or 2% a day or 20% a month or whatever that number is, how are they generating the returns to be able to pay you that? And if they can't prove that they're doing that, that is a huge red flag. We've got to see that transparency. What is it that they're doing? Okay, so they need to be able to prove that they're making those returns. And it's easy to just say, oh, we've got an AI trading bot that gets great returns. Well, that sounds nice. Prove it. Anyone can say that, okay? How many people really have an AI trading bot that was custom designed for them? Not very many. but a lot of them say that in their marketing. And so what we do is we work with several projects that have a Telegram channel that actually posts every trade they make. One of them that I'm in that's doing really well. They have over 200 times a day. I'll get a notification of this was bought at this price, sold at this price. Here's the return. Boom. I know exactly what trades they're making, and what happens is that company is also so transparent. We know how much money is in there. We know how much is made every day, and then when we get paid out, we know to the penny that this is what they're making. That they're not making this up. That this is actual trades, actual money being made. That is super important. Transparency. Okay. Now, there are some that also have links to third-party organizations that enable you to confirm the trades. And so I know there's one called Dune, and there's someone will use the BSC blockchain, and there's just different things like that where you can go on and see if they say, hey, we made this trade, boom, there it is. There's proof that it really did happen. So transparency, making sure that they're really making the money that they say they are, so they can pay the returns that they're paying. Another thing we look for are reasonable commission numbers. And so a lot of these opportunities, they're multi-level marketing. That's a little bit of a red flag, but that's not a deal maker or a deal breaker. See, most companies in almost any industry, the average spent on marketing is about 20% of sales. So if a company is spending 20% of their revenue on marketing, and it just happens to be in the form of multi-level marketing, that's okay. Not ideal, but that's okay. But I'll tell you one example. This is an actual example from a month ago. There was an opportunity that came out. I will say it lasted about 3 weeks. We passed on it. But first level commission was 25%. Second level was 15. Third was 10. And it went on down about 10 levels from there. They were paying out 57% commission right off the bat, right up front. So you put in $1,000, somebody's getting up to 570 of that. But it gets worse. They actually had bonuses. If you did a certain volume, did a certain this, certain that, recruited a certain number of people, the bonuses were up to 40%. In other words, they could be paying out as much as 97% of what was coming in. There is no way that would be sustainable. And so that's an extreme example, but even when you start to see commissions in the 20, 30, 40% range, that's a big red flag. And so again, we do work with some multi-level marketing companies, and you just have to take a look at the numbers and see, do they make sense? Are they reasonable? So that's one thing that we take a look at. Again, I'd honestly rather see companies paying 2 to 4% because that tells me it's going to be more stable. Okay, so that's one thing we take a look at is the reasonable commission numbers. Another thing we look for are reasonable return numbers. So some traders do make amazing returns. 1% a day, 2% a day, sometimes even 3% a day on a good day. That's great. The thing is, those returns aren't flat. They're not the same every day. So if someone says, hey, we're going to pay you 2.4% a day every day, okay, as long as they're making 2.4% every day, that works. But man, that's a high return, and it's a fixed return. What happens if they have a stretch where they only make 1.5% to 2% a day for a few days? Now they've fallen behind, and they don't have enough money there to pay what they say they're going to pay. And so that's kind of snowballs and becomes an issue. And so the higher the return, when it's a fixed stated return, the bigger the risk is. What's actually a better approach is when there are variable returns based on actual results. I would much rather have, and again, I have several funds that are like this, I'd much rather have situations where, hey, we had a great week, we made 10% this week. Next week, it was kind of a rough week, we only made 6. We only made 3. Okay, and then the next week you make 7 again. That's fine. I'd rather it be variable, but actual returns made, as opposed to, hey, it's fixed, and hopefully that's how much they're making. We just don't know. So that's just one thing we look into. Again, it's not a deal killer, but it's a red flag that we want to pay attention to. Another thing we look at are values based on a token. See, I really don't like those, and the reason is there's a lot more risk there. And I'm just going to share one example, and it'll make it pretty clear. And this is from an actual project over the last 3 to 4 months that was quite popular. It's been around for a little while, but here's what happened in the last 3 or 4 months. If you'd put in $10,000, that project is saying, hey, we're going to pay 1% a day. That's pretty good. So you put in $10,000 and you get 1% a day. But when you put in that $10,000, it converts to their token. That 1% is a 1% return on their token, on the value of their token. So what has happened in the last 3 months, that token price has dropped 80%. So if you put in $10,000 3 months ago, that $10,000 of US dollars is now worth 2,000 US dollars based on the price drop of their token. And so they're still paying a 1% return, but it's now 1% on that 2,000. So now you're making $20 a day instead of $100 a day. You thought that you're going to be making it was about 22% a month, and now you're making about a fifth of that. You're making about 4% a month. Again, it's still making money, but not nearly what you thought you were going to have because it's based on that token. And here's the worst part: you're stuck hoping that price recovers of that token. What if it keeps going down? Then your return just keeps going down. Hopefully it recovers. If so, great. But do you want to sell that token at $2,000? When you put in 10, probably not. I mean, it just puts you in a really difficult position. Therefore, we try and avoid projects that have tokens that determine the value of your returns. Another thing we look for is a cap on the fund. And a lot of people don't like caps, but if you understand why they're there, it really makes sense. So let's say you found this awesome trader, okay, and he can earn 1% a day every day, like clockwork. And he's got $1 million and he can get a 1% return on that $1 million every day. Fantastic. Well, could he get those same returns if he was trading $1 trillion? No. There's just not enough market cap for him to be able to trade $1 trillion and get a 1% return per day. There's not enough options. There's not enough market. There's not enough volume. It can't happen. What about $1 billion a day? Who knows? Maybe he can, maybe he can't. That's an awful big number. And so the point of that is the returns get harder to generate the larger the fund is. Okay? So the responsible funds that I've seen, they cap the value of their assets. And a couple of the largest ones I've seen, they may cap it at $250 million. I've seen a lot of caps. Most of them seem to be in the $25 to $50 million range. They know that, hey, once they get above that, they're going to have a hard time meeting their returns. I've seen some caps as low as $1 million. The trader knows that, hey, based on what I do, I can get consistent returns. And this particular one, I mean, he gets 3% a day. But he also knows that once it gets over $1 million or so, he won't be able to generate that type of return. So he had a cap of $1 million on that fund. And so just something to keep in mind when you see the cap on the fund, it just tells us that the management is being, they're putting thought into it and they know what their limits are. And so that's kind of important. Another thing we look at is the liquidity of the gains. So we prefer to see gains that are liquid either daily or weekly. Monthly is tolerable. As long as you can take out the gains at least monthly, that's okay. But if it's less often than that, if you can't take out the returns for 2, 3, 6 months at a time, that's concerning. And that's something that we usually avoid just because it means that things are just tied up for a little bit too long. So that's a bit of a red flag for us. The other type of liquidity we look at is the liquidity of the principal. And so there's a little bit of a give and take here because you don't want too much liquidity. You want the traders to be able to use that money and know how long they're going to have it. And so if you have something where it's liquid every single day, the trader never knows how much they're going to have to work with the next day. And that really makes trading difficult for them. And so it's actually best if it's tied up for at least 7 days. So the trader knows, okay, for the next 7 days, I've got this much to work with. So it's usually best to see things have principal that's not liquid for at least 7 days at a time. Honestly, a lot of the times we see it's 30 to 90 days that the principal is tied up, and I'm fine with that. That's okay. But when you start seeing it longer than that, it becomes a little bit of a concern when your liquidity is tied up for months at an end, and I won't go past a year. If the principal is tied up for more than a year, there's just too much risk, in my opinion, to tie it up for 2 and 3 years or even longer in some cases. So again, that sweet spot is kind of 30 to 90 days. We'll go a little bit longer than that if we need to, but just how long is that principal going to be tied up? One interesting thing related to principal is that there are some in which the principal is never liquid. So there's projects that may pay a certain return up to a certain percentage. For example, I know right now there's one that pays 1% a day up to 200%. There's another one that pays, I think, 1.25% a day up to 250%. There's one that pays 1% a day for up to 365 days. And so the returns are decent, and from a company standpoint, it provides them a lot of protection. There's never going to be a run on the bank because they're never giving back they're never giving back principal. But from an investor standpoint, we don't get the infinite cash flow. And so you put money in and it makes money for 6 or 8 months, maybe a year, and then it's done. So you have to continuously keep reinvesting if that's the case. Like I said, it's good for company strength to avoid bank runs, but it's just not good for us for infinite cash flow. But again, just keep that in mind when you're looking at projects, that there are some in which the principal never gets returned. They just pay a percentage return to you, and once they hit a certain cap, they're done. So those are all the different things that we look at when we're evaluating a project and to determine whether or not it makes sense. And again, if they pass every single test, it's not a guarantee, but at least doing those due diligence steps weeds out a lot of the crappy projects. And to give you an idea, I have now looked at over 240 projects, 240, and have invested in less than 10% of them. Like I said, I think I'm up to about 23 or so that passed enough tests for me to feel comfortable. And quite frankly, I'm even more strict now than I was a couple months ago. So keep that in mind. Do your due diligence. Protect yourself.